Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, definitely hit like and also hit subscribe so that you can see future videos as well. So today what we're going to talk about is what should a company do with its profits. So pretty general question, but there's definitely a lot of different options companies can take. There's really three main ones in my head. So if we're talking public companies specifically, they can either pay a dividend, they can reinvest in their business, or they can buy back shares. Those are the three things that have the potential to benefit shareholders in terms of, doing something with that cash. There's certainly other options that don't benefit shareholders. They can buy a larger private jet, they can pay themselves some more money, they can do all of those sorts of things. But the three that I mentioned earlier, those are really the ones that drive wealth creation long term for shareholders of that company. So I want to run through each of those individual options, what they mean, what's the best one for a company to do, and how that varies depending on the situation with that company. So let's get into it. Alright, so first off, just a very brief overview of what those three things actually mean if you're not familiar with them. So firstly, a dividend, that is simply a cash payment to shareholders. So if a company makes money, if they make profits, one of the options that they have for that money is to give it back to the shareholders, give it back to the owners of the business. Just like if you owned, a dairy down the street, or if you owned a laundromat, or if you own a rental property, whatever it is, when that business makes money, you as a shareholder or as an owner of that business have often a right to, have that money come into your pocket. So that's basically the first option is a dividend, simply just a cash payment out to you as a shareholder. The second one is a share buyback. So a share buyback, as the name suggests, is literally that company going out and buying its own shares. So Apple, for example, has a large share buyback program going at the moment. Apple are going out and buying back their own shares. And this has the effect of basically concentrating the ownership of remaining shareholders. So for example, if Apple has, and I'm completely making this number up, but if Apple has, 100 million shares, if they go out and then buy back 10 million shares, they've reduced the number of shares out there by 10%. And the remaining shareholders now own the same number of shares, but there's less kind of total shares in the universe, so they therefore own a larger percentage of the company. This is something that is pretty prolific out there at the moment. A lot of companies making a lot of money, so they're putting it all into share buybacks, and it's very beneficial for shareholders over the long term. So Warren Buffett's investment in Coca-Cola, for example, he bought into, I think it was around 7% of Coca-Cola in the 80s. He now owns right around 9 or 10% of Coca-Cola simply through share buybacks. He hasn't laid out a single dollar more to continue that investment in Coca-Cola. Instead, Coca-Cola have bought back shares. They've increased Buffett's ownership percentage in that company, and that's basically should be reflected in the stock price over the long term. So that's share buybacks. The third one is a little bit more complicated, and this is going to vary a lot between individual businesses, and that is reinvesting back into the business. So essentially it is funneling money back into the company, funneling those profits back into the company to grow the business. So if you're a car company, for example, this might be building a new factory or releasing a new model. If you're Facebook, it might be buying Instagram like they did back in the day. It may be funneling money back into development for the Facebook or Instagram platform. It may be advertising. If you're Geico, the insurance company that Buffett owns, they put a lot of profits back into advertising and trying to grow the business that way. There's a whole range of things that companies can spend money on in order to try and grow that business. So those are basically the three options. I want to run through which is best for you as a shareholder. There is not necessarily any right answer to this that we can apply to every company. It does vary across different companies as to which one will be the best. But I'm going to run through, I guess, my preference and my, in a perfect world, which ones I'd have that company doing. And then you can make your own decisions on maybe the companies that you're looking at or the companies that you own as well. So let's get into that. So the use of that capital, the use of those profits that I want to start out with first is the one that's my favorite, and that is reinvesting into the business to grow it. And there's a couple of really key things that you want to look at here. So there's two pretty major financial ratios that we really want to focus on with this one, and that is return on equity, ROE, and return on invested capital, ROIC, or sometimes just called return on capital. So what those two ratios represent, let's start with return on equity. Basically, that's looking at all of the equity in the business. So all of the assets that business owns minus any liabilities. So, if they own a whole bunch of factories, you're taking the value of those factories, any inventory, that sort of thing, and then removing any debt that the company has. And that kind of difference, that sort of net worth on the balance sheet is equity. That is shareholders' equity in the business. And when you look at a ratio called return on equity, that is looking at what sort of return are they generating on that equity. So, for example, if you have an equity value of $1 million and that company generates $100,000 a year in profits and net income, then that is a 10% return on equity. That's basically what that means. So, when we look at businesses that want to reinvest this money back into their business, we want that business to maintain a high return on equity. Basically, that's the return that the company is likely to generate on this cash that gets reinvested. So if they, make that $100,000, like I said, they've got a few different options of what they can do with it. If they plow that back into the business and expanding factories or into advertising or whatever it is, we want to make sure that the return on equity or the return on invested capital, which I'll get to in a sec, is high. So what that means is if they plug that $100,000 back into the business and they're earning a return on equity of, say, 20% a year, or 20%, that means that we are going to get a $20,000 return straight away or over the next year from that capital that's reinvested. And that is basically, that's the return that we have to compare to what could be done with the money if it was paid to us as dividend. So for the average investor, you're not going to be able to make 20% a year. I hate to break the news to you, but that's something that is fairly unlikely that you're going to be able to do sustainably over the long term, at least, unless you happen to be Warren Buffett. So if we can redeploy that money into a business that earns 20% a year on that capital, that's fantastic. If they pay it to me as a dividend, I have to find somewhere to redeploy that capital myself. I have to invest it in another business or whatever it is. And that is much trickier than the business sucking up that profit themselves and growing the business that way. So that's definitely my preference. Return on equity is the main one to keep an eye on. There is also return on invested capital. So it's a very similar metric, return on invested capital. It's looking at the return on the equity, but it's also looking at invested capital being equity plus debt. So if the company has $1 million of equity and also $1 million of debt, they have $2 million of invested capital, and you're looking at the return relative to that $2 million. So if, again, they're making $100,000, but they've got $2 million of invested capital, then that is a 5% return on invested capital and a 10% return on equity. So they've sort of lifted up that return on equity by taking out some debt, but there's obviously more risks and things associated with that. So as a general rule of thumb, personally, I'm happy if return on invested capital and return on equity are both north of 10%, because 10% is a pretty solid return to make generally in the stock market. So if they pay that cash to me, that's sort of I suppose a yardstick that I'd have to get to myself if the company wasn't able to make a 10% return and do that themselves. So that's the first thing that a company can do with its profits to grow shareholder wealth over time. Basically, over the long term, if they're doing this very well, it should have the effect of growing the stock price quite dramatically over time. So we've seen this in companies like Facebook. They've never paid a dividend or anything. They have done share buybacks, but never paid a dividend. They've continued to reinvest in the company, acquire other businesses, grow the Facebook platform, develop the Instagram platform, and that's done wonders for the stock price over the last 10 years. So those are some of the benefits, and that is definitely my preference. It's less work for me. Company does very well. They can expand into all these other ventures and do great things for my own personal net worth if I'm invested in that company over time. So that's the first one. Let's get into share buybacks and then talk dividends as well. So let's assume that the company cannot invest further money back into the business and earn a high return on it. There's definitely businesses out there that are sort of mature and are either slow growing or really have no growth, or they may be growing but don't require extra capital, which is the ideal business. So, what do we do with that money? There's, like I said, a couple more options. So dividends or share buybacks. And personally, I have a general preference, and I've made videos on this in the past. I have a general preference for buybacks for reasons which I'll get into in a sec. My view on that has probably softened a little bit, to be fair. So I still do have a general sort of preference for buybacks, again, because if someone's paying me a cash payment, I have to do something with that money. There's also tax differences, and I'm not going to get into that too much today because that'll vary depending on where you live in your specific tax situation. It's going to vary if you're investing in a tax advantaged account in the States versus me in a regular account here in New Zealand, and all those sorts of things. So I'm not going to dive into tax too much. But there's certainly work for me to do if I get paid a dividend and have to redeploy that somewhere else. So that is why I've sort of had a general preference for buybacks in the past. Like I say, my view's softening on that, particularly right now. So the real benefit of share buybacks, like I said, is concentrating the ownership of existing shareholders or shareholders that are remaining after those buybacks over time, making them larger percentage owners in the business and really having that reflected in the stock price over time. There's one major caveat to that. So you have to be buying back shares at a reasonable price, and this in a lot of cases is where things fall over. So if a company has an intrinsic value of, let's say, $200 a share, you've figured that out, or the company management's figured that out based off the current cash flows of the business and what the expected cash flows are in the future. Again, not going to get into those sort of calculations in this video, but let's say the company has an intrinsic value of $200. If the shares of that business are trading for $100 or $150, it is absolutely in the benefit of the shareholders to go out and buy as many shares as you possibly can with that money. You're making an instant return on that buyback. So if the shares are trading at $100 and they're worth $200, then every share that you buy, you're making a $100 return instantly, and that is phenomenal for shareholders. You're making 100% return on that equity that's redeployed. That's phenomenal. It's still very good if you're buying, those $200 shares for $150. This is all fantastic stuff for owners of that business over the long term. So if they're in that situation, absolutely love buybacks. I don't think you can get much better than that. And that even if the price difference between price and value is that significant, you're actually going to get a better return doing that than reinvesting in the business for growth. And there's obviously headaches and things that come along with a larger business as well. They're more complicated to manage. You have to sort of plan out these projects, and there's risks that they won't necessarily do well over time. So in that situation, buybacks are pretty hard to beat. Where it does fall over, and the reason I say I don't have quite as strong as preference for it right now, is because prices are sky high. It's as simple as that. People are out there buying back $200 shares for $250 or $300 at the moment, and that is value destructive over time rather than something that creates value for shareholders over time. So that's something that's happening at the moment, and as a practical kind of measure, one of the things I would say to look at when you're assessing company management is to see whether they actually understand this concept or not. So if you're investing in a company that says something along the lines of, we're going to repurchase shares opportunistically, that is great news. That is music to my ears. It means that the company management is paying attention to the price, and they're only going to buy back shares when they believe they're getting a good deal, when they believe they're getting a discount to intrinsic value. That is, that's nirvana. That's exactly what we want to hear as shareholders when we're invested in companies that buy back shares. The last thing you want to hear as a shareholder is a company that says something along the lines of, we're going to buy back $2 billion worth of stock this next quarter. And they fail to even mention the price. They just say, we're just gonna throw this money out there and we're gonna buy back shares with it. We're gonna continue to do that regardless of what the price is. They won't actually say regardless of what the price is, but that's what they're literally gonna do. They're just gonna keep buying back shares and deploying this money into buying back shares. If you hear that and you don't hear, that they're gonna do it opportunistically, or they don't, they're not going to do it at a certain price or anything like that. That is where I start to, question whether the management truly understands, efficient allocation of capital and growing wealth for shareholders long term. You don't want to see people buying $1 for $2. You want to see people buying $1 for 50 cents with share buyback. So, those are some thoughts on share buybacks. Definitely have a preference for them over dividends if it's done properly, and I even have a preference for buybacks over growing the business if it's done properly for the reasons I just mentioned before. So let's get into the third way that these people can use your money when they make a profit in this company, and that is through dividends. So with dividends, the first situation in which I'd prefer a company to pay a cash dividend over a buyback or reinvesting in the business is for basically the reasons I've just mentioned before. So if we go down the kind of the preference list, I suppose, again, depending on the price, the reinvesting in the business or the buyback may be first or second. Those might flip around, but let's say reinvesting in the business is the first option. Let's take a situation like See's Candy. So See's Candy is a business that's done phenomenally well for Warren Buffett, and one of the great things about See's Candy is it throws off a lot of cash every single year. One of the very poor things about See's Candy is they have tried freaking everything to try and continue growing that business. They've tried new products, expanding into different countries, all this sort of stuff, and it just flat out hasn't worked, to be honest. So basically, See's Candy is now in a situation where their growth is stagnant, if not just growing at inflation, basically. But the company continues to throw off all this cash, and basically Buffett has to do something with that. So that's a situation where a company will want to pay a dividend. So if they, in See's Candy's situation, go out and spend a whole bunch of money on trying to, advertise chocolate in the UK or in Sri Lanka or India or, New Zealand or some other country, they're not going to get a good return on that. They've tried that, it's failed. Return on equity is going to drop if they do that. Return on invested capital is going to drop if they do that. So their next best option is to pay a cash dividend. Particularly with See's Candy, where they have one shareholder, Berkshire Hathaway, so share buybacks are not an option. That just leaves the dividend option. So that's a situation where you want to pay a dividend. The next one is if share buybacks aren't going to work. So either, like I said, you're a wholly owned subsidiary. You are the sole owner of this business. Buybacks are not an option. You can't buy out yourself. So that's a situation where you're going to want to pay a dividend. Or if the price is too high, and this is where the true really good capital allocators, the really good managers of businesses that understand this stuff really well, that's where they will choose to pay a dividend. One of my pet peeves, I suppose, which I'm probably in the minority camp here, is companies that just pay a blanket dividend for no particular reason other than they've done it forever. I really believe that dividend amount should be going up and down all the time, depending on what the stock price is doing, and not because I think the stock price has anything to do with the underlying business, but because the stock price moving up and down either gives us great opportunities or very poor opportunities to buy back shares opportunistically. So if the shares are trading at a big 50% discount, I don't think you should pay a single cent in dividends. I think that should all be plowed straight into share buybacks. There's going to be objections from certain shareholders that, enjoy this cash flow or are subscribed to PPC Ian or whatever it is. Shout out Ian. There may be objections to that, but strictly capital allocation speaking and return on investment speaking, that's going to be the best thing for shareholders long term. So if the share price goes way above intrinsic value, great, pay it as a dividend. You can't, you're out of options basically. You can't grow the business and you can't buy back shares efficiently. Pay a dividend. If the price comes way down, I think you should at least be trimming that dividend. If the company's more profitable than it was last quarter, maybe just maintain it and then put the difference into share buybacks. So those are my thoughts on what our company management can do with the profits that it produces. A bit of a long video, I think, but I really hope you enjoyed it. There's some pretty powerful stuff in there in terms of what that will do for the return on these investments and the wealth creation for shareholders long term. So I do hope you enjoyed it. If you did, definitely hit like, hit subscribe, and I will see you in the next video. Cheers.